In these uncertain times, it's easy to feel confused, frustrated, or even scared every time you think about investing in the stock market. You know it's important to save money for your retirement, but with the election adding to all the talk of stock bubbles, financial crisis, and corporate bankruptcies, it can make you wonder if you'd be better off burying your life savings in the backyard. In this video, we'll break down some basic terminology and review the market's performance after and during each of the presidential elections from 1926 until our current administration. Whether you've been investing for years or just landed your first real job and are wondering how to get started, it's important to understand some simple terminology so you know how to respond to the information being given. Let's start with some of the basics. The market. When the media says the market, they're typically referring to the S&P 500 or the Dow Jones Industrial Average. The S&P 500 is a market capitalization weighted index of the 500 largest U.S. publicly traded companies, while the Dow is a stock market index that tracks 30 large publicly owned blue chip companies trading on the New York Stock Exchange and NASDAQ. Each of these can be thought of as a sample of how the overall market is doing, but it's very unlikely that your own investments will follow the indexes exactly unless you're purely invested in an index fund tracking one of the two specific indexes. If you invest in more conservative investments, then your account value may not move as much as the reported index number. Similarly, if you're invested in riskier investments, it's possible that your account value will move more than the reported index moves. The market is up or the market is down. When someone says the market is up by 5%, what do they mean? Well, it could be referring to the previous day, week, month, or year, so it's important to understand which time frame is being referenced. Oftentimes, they're referring to the price the index closed at the prior day. So when they say the market is up 5%, they mean it's trading 5% higher than it ended the day yesterday. A bull or bear market. A bull market is a term to indicate that the market is in an upward trend and expected to gain even more, whereas a bear market is a term to indicate a downward trend in the market. It's important to note that a single stock, a sector, or the market as a whole can be bullish or bearish. So again, make sure you're paying attention to what is being referenced. Volatility. Volatility isn't necessarily a bad thing. It references price movements of a single stock or the market as a whole. High volatility, on the other hand, can cause stocks or the market to be very unpredictable, causing the price to fluctuate in very short amounts of time. Portfolio. A portfolio is a collection of investments owned by a single investor or group of investors. You can have as little as one stock in your portfolio, or you can have into the thousands and tens of thousands. Rate of return. The rate of return is the net gain or loss of an investment over a specified time period, expressed as a percentage of the investment's initial cost. Essentially, you're calculating the change in the value from the beginning of a certain period until the end of the selected period. Let's say that you invest $1,000 into an S&P index fund that identically tracked the index. Now, let's assume that the market is down 10%. This means you lost $100. Now let's assume the market goes down another 10%. Since you had $900 left in your account, you're not down $100 this time, but $90, so you have $810 left in your account. Let's again assume the market goes down another 10%. This time, you lose $81 and are left with $729 in your account. As you can see, when the market was down 10% on the third day, you lost $81, but when it was down 10% on the first day, you lost $100. It's important to keep a proper perspective when listening to the latest news, as headlines are often designed to grab attention without telling the whole story. Now that we've discussed some of the terminology, let's dive into the historical numbers. Here's a look at the stock market's performance over each presidential cycle from 1928 through 2019. As you can see, the S&P 500 price index has been mixed. Rather than focusing on the election, it's important to take a long-term approach when dealing with the markets. Let's take a look at the growth of a single dollar invested into the S&P 500 in 1926 through 2019. You will see that both parties experienced loss and growth. The most important thing to do is to keep a cool head. Speak with your financial advisor to review your goals and investment strategy. And remember that by focusing on the long term and avoiding the short term drama, you're more likely to make positive investing decisions. If you enjoyed this video and want to learn more from the definitive channel for financial education, don't forget to like, subscribe, and comment. We'd love to hear your ideas on topics you'd like to see covered. As always, thanks for watching.